All right, folks, welcome back to FinQuiz. Today, we're kicking off the last learning module in the alternative investments topic area. And this one's a hot one. We're going to talk about the wild, sometimes wacky, but definitely relevant world of digital assets. Now, before you roll your eyes and think, oh great, another crypto buzzword soup, let me stop you right there. Whether you're a fan of Bitcoin or still wondering what the heck an NFT is, this section is about how digital assets have become a serious part of investment portfolios. And yep, they are testable, so let's make sure they don't surprise you on exam day. So what are digital assets exactly? Think of them as electronic assets that carry some kind of ownership or usage rights, but instead of being stored in a bank vault or held on a piece of paper, they live entirely in digital form. Some examples: cryptocurrencies like Bitcoin or Ethereum, tokens issued by blockchain-based platforms, and digital collectibles. Yeah, those funky cartoon apes people have been trading for millions. Don't worry, we'll get to that later. What makes these assets secure is a little piece of tech magic called distributed ledger technology, DLT, the most well-known form of which is blockchain. Basically, it's a super secure, decentralized way of recording transactions. No central authority, no tampering, no oops, we lost the file. Just a trustless system that lets people verify ownership and activity transparently. Now here's the part where it gets real interesting. Digital assets are not your grandfather's investment. These aren't stocks or bonds. They're fast evolving, often volatile, and built on technology that only came into the mainstream in 2009 with the launch of Bitcoin. But since then, we've seen an explosion in growth, investor interest, and innovation in this space. Now, why should you care? Because even though these assets are new, they're offering diversification and potentially higher returns, especially for those willing to stomach a bit more risk. Think of hedge funds and institutional investors. They're already in the game. Some pensions and endowments are even allocating a slice of their portfolios to crypto funds and tokenized assets. But, and this is important, they're not all sunshine and rainbows. These assets can be super volatile. And let's not forget the regulatory uncertainty. One tweet from a regulator and boom, your crypto portfolio takes a nosedive. So yeah, there's risk, but there's also opportunity. So to sum it up, digital assets include a wide range of instruments like cryptocurrencies, tokens, and collectibles. They're powered by encryption and blockchain, growing fast since 2009, offering higher returns and diversification, but also bringing volatility and legal questions that make them anything but boring. And that's exactly why CFA Institute has added this to your exam, because whether you're managing high net worth clients or working at a fund, chances are digital assets are going to come up in real life. And you need to know the basics cold. Next, we'll break down the types of digital assets and how they're categorized in the market. Trust me, it's like stepping into the matrix, but with investment returns attached. Now, before we jump into the nitty-gritty, let me remind you that FinQuiz has been a trusted companion for thousands of successful CFA candidates over the years. The PDFs you see on your screen can be purchased and downloaded. They'll make your preprint review sessions a breeze and are incredibly popular with folks who've already aced the exam. So if you haven't already, give them a look and see if they fit your study style. Now, let's get rolling. Okay, let's take a deeper look now into what really powers the entire digital asset ecosystem, and that's something called distributed ledger technology, or just DLT for short. If digital assets are the apps on your phone, DLT is the operating system they run on. And trust me, this isn't just a tech buzzword thrown around by crypto bros. This is the infrastructure that makes Bitcoin, Ethereum, smart contracts, NFTs, and all those headline-grabbing tokens possible. We'll cover these terms in this lecture, folks. But first, let's see, what exactly is DLT? Imagine a giant Excel spreadsheet, but instead of sitting on one accountant's laptop, it's shared across thousands of computers. And every time something changes, like someone sends Bitcoin or a token is created, that update gets recorded across all copies of the spreadsheet simultaneously. That's DLT in a nutshell. It's decentralized, secure, and visible to everyone on the network. Now let's talk benefits. DLT offers some clear advantages over traditional centralized databases. For one, it's accurate because every transaction gets double and triple checked by independent parties. It's also transparent. You can trace ownership and transaction history in real time. It provides secure record keeping, which is a huge upgrade from outdated paper trails. And it allows faster ownership transfer since you don't have to wait for banks, brokers, or regulators to clear a transaction. Best of all, it facilitates peer-to-peer transactions, cutting out intermediaries and reducing cost. But hang on, it's not all sunshine and innovation. There are some serious limitations too. DLT systems, especially those using proof of work, can consume more energy than some small countries. Not even joking. And while they're secure, they're not invincible. There are still vulnerabilities in terms of privacy and data protection. So CFA candidates, don't forget, this will likely show up as a weigh the pros and cons question. All right. So what makes a distributed ledger technology network actually work? There are three key elements you need to understand. Let's walk through them. First up, the digital ledger. Think of this as the master record book. It's a shared database of transactions that every participant on the network can access. It's not locked away in some central server. It's distributed. Everyone has the same copy. So when a new transaction is added, the entire network knows about it. It's open, synchronized, and tamper resistant by design. Second, the consensus mechanism. Now, this is where the magic happens. Think of it as that moment when your family all agrees on where to go for Thanksgiving dinner. Someone makes a suggestion, people talk about it, and once you've got the majority on board, you proceed. On a DLT network, consensus happens when transactions are validated, and everyone in the network basically says, yep, we're all good with updating the ledger to reflect these transactions. Doing this in near real time is what gives DLT its transparency and efficiency. Plus, cryptography helps keep it all secure by verifying identities and preventing unauthorized access. So folks, the consensus mechanism is the system's way of making sure that everyone agrees on what's valid. No rogue transactions, no conflicting records, just clean, synchronized data. It works in two main steps. First, there's transaction validation. Nodes check if the transaction follows all the rules. Each node is checked to make sure it's legit. Then they agree on the ledger update, essentially locking it in across the network. This process ensures real-time transparency and trust, even when the participants don't know or trust each other. It's the engine that keeps the whole system fair and secure. Boom. Once that happens, the transaction becomes permanent and visible to all. No secret backroom deals. So, consensus tells how the system agrees on what's true. No referees here. The system itself does the policing. And finally, the participant network. This is where things get really collaborative. This is the community of users or nodes that make the system tick. Each node plays an active role in verifying transactions. It's completely peer-to-peer. No central middleman, no headquarters, just a bunch of participants keeping each other honest by checking, validating, and updating the ledger. Picture it like a giant digital group project. Every node or participant in the network is constantly verifying transactions. There's no central authority calling the shots. Instead, it's a peer-to-peer setup where each participant acts like a referee, checking everyone else's plays. That's what gives DLT its transparency and trustless structure. It's not about trusting one source, it's about trusting the system because everyone is watching everyone. Together, these three components, the digital ledger, the consensus mechanism, and the participant network, form the backbone of any DLT system, from Bitcoin to enterprise blockchain solutions. Take, for instance, Ripple, used by several banks for cross-border payments. It operates on a permissioned version of DLT, meaning only authorized players, like specific banks, can validate transactions. And the beauty, it settles in seconds, not days. That's a real-world example of DLT replacing outdated systems like SWIFT, which still moves money like it's 1998. But how do we ensure security in such a system? That's where cryptography steps in. Every participant has a digital identity that's masked and encrypted. You can see what's happening, but you can't easily tell who's doing it. That's what allows privacy while still maintaining transparency. It's the financial version of having your cake and eating it too. And here's something that really excites fintech folks: smart contracts, which is just fancy talk for self-executing programs that trigger automatically when certain conditions are met. These are basically if-then rules built directly into the blockchain. They execute automatically when conditions are met. No lawyers, no delays. Let's say a borrower defaults on a loan. A smart contract could automatically transfer collateral to the lender. It's finance on autopilot. Picture a mortgage that automatically releases the deed to the buyer the instant the final payment is made. No bank middleman required. That's the promise of smart contracts. Keep that in mind because the exam might throw a question at you about applications of DLT in areas like collateralized lending or trade finance. Want a real-world example? Think of Uniswap. It's a decentralized exchange that uses smart contracts to match buyers and sellers without a middleman. You want to swap Ethereum for USDC? The contract does it instantly, no human involved. That's not science fiction, it's already live. Among different types of DLT systems, you'll hear the word blockchain a lot. Blockchain is basically one popular way to implement a distributed ledger. Think of it as a chain of blocks, each block storing multiple transactions and each block referencing the one before it with a cryptographic hash. That chain of hashes is what keeps the sequence locked in. If someone tries to tamper with one block, they'd have to redo all the subsequent blocks, making manipulation astronomically expensive. Picture a digital notebook with blocks of data. Each block contains a group of transactions, and it's cryptographically linked to the one before it, hence the term chain. You can't change block 101 without also changing block 100, block 99, and so on. It's practically impossible to tamper with unless you've got massive computing power and time on your hands. Basically, it's secure by design. Now, let's see how a transaction gets added to the blockchain. First, someone initiates a transaction. Let's say Alice wants to send 1 Bitcoin to Bob. That deal gets packed into a block, which then gets broadcast to a network of computers. These computers, called nodes, race to validate the transaction. Once validated, it gets verified into a complete block, which then gets cryptographically linked to the last one in the chain. Finally, it's added permanently, and every copy of the blockchain gets updated. It's like notarizing a document, then immediately mailing a certified copy to thousands of people worldwide. If someone tries to fake a version, everyone else still has the original. But how do we ensure trust without a central authority? That brings us to the two big dogs of consensus protocols, proof of work and proof of stake. If you're studying for the CFA, you'll need to know the difference between proof of work, POW, and proof of stake, POS, because they're two major consensus mechanisms. Let's start with proof of work, or POW. It's what Bitcoin uses. Here, miners compete to solve complex math puzzles. First one to solve it gets to validate the block and earns crypto rewards. It's like a high-stakes Sudoku tournament happening every 10 minutes. The upside, it's very secure. The downside, it's wildly energy intensive. Think server farms the size of warehouses running 24/7. So, proof of work is computationally expensive and requires a ton of electricity, which is partly why Bitcoin mining has been criticized for its environmental impact. But on the flip side, that cost is what makes it secure. If a bad actor wants to manipulate the blockchain, they need to control more than half the mining power, and good luck pulling that off without spending billions of dollars on hardware and electricity. In contrast, we have proof of stake, or POS. No puzzle solving here. Instead, validators stake their own crypto as collateral to get permission to verify transactions. If they try to game the system, they lose their stake. It's cleaner, faster, and much more energy efficient. So instead, validators stake or lock up some of their cryptocurrency as collateral. They're then randomly chosen to propose new blocks. If they approve fraudulent transactions, they risk losing that stake. It's far less energy intensive than proof of work, and that's why it's gaining popularity. Ethereum's recent switch from proof of work to proof of stake, huge news. It's part of a broader shift in the crypto world toward sustainability. And CFA Institute loves this topic because it shows how innovation meets economic reality. Now, let's talk about permissioned versus permissionless networks. Okay. There are permissionless networks like Bitcoin where anyone can join, verify, and transact. These are open, fully decentralized, and trustless. No need to know the other party and no central authority. All transactions are publicly visible, there's no central authority, and the records can't be changed once they're in the chain. This works well when you want complete decentralization and don't want to trust anyone. Then there are permission networks. These are closed off. You need authorization to join. Permission networks impose restrictions on who can join, view, or create transactions. Picture a private ledger among big banks. Only certain approved entities can participate. That might be more efficient and cost-effective than a permissionless system, and it can be partially decentralized without letting just anybody see or change the data. Think corporate blockchains used for internal supply chain tracking. Walmart, for example, uses a permissioned blockchain to trace food from farm to shelf. If there's a contamination issue, they can trace the problem to a specific farm in seconds instead of days. Now, a quick comparison, folks. Permissionless networks are open to all. Slower, higher cost, fully decentralized, whereas permissioned networks are closed, faster, more efficient, and have controlled governance. It's like comparing Wikipedia, anyone can edit, to a private company intranet. Only employees have access. Both use digital record keeping, but the structure and rules are totally different. So, speed, cost, governance, these elements all differ between permissioned and permissionless networks, and you might see a question on the exam that asks you to compare these features. The important distinction is that permissionless networks aim for maximum decentralization, while permission networks keep a bit more control in the hands of selected participants. All right, so folks, what we have learned so far is that DLT is the backbone of the digital asset world. Blockchain is the most famous form of it. Consensus mechanisms like proof of work and proof of stake help keep the system secure. Smart contracts are the automation layer, and networks can be open or closed depending on how much control is needed. And more importantly, every single one of these terms is fair game on your CFA exam. Expect comparisons, definitions, and application-based questions. The Institute wants to see whether you understand not just what these terms mean, but how they actually function in real-world finance. All right, deep breath, grab a sip of coffee, because up next, we're going to explore the actual types of digital assets, from Bitcoin and CBDCs to NFTs and governance tokens. This is where the definitions get colorful. Okay, folks, let's slow it down here, because this is where candidates often think they know the topic, until the exam hits them with a curveball. You've heard terms like Bitcoin, NFT, crypto, probably even at dinner. But for the CFA exam, and more importantly, in the real investment world, you need to break down digital assets into two broad categories: cryptocurrencies and tokens. Now, let's start with cryptocurrencies. So cryptocurrencies are basically digital assets that allow for near real-time transactions without needing a middleman. No banks, no brokers, no red tape, just you, your device, and the blockchain. But here's the important bit. These aren't issued by governments. They're launched by individuals, companies, or communities. Bitcoin, created by an anonymous individual. Ethereum, developed by a group of coders and tech visionaries. Dogecoin, honestly, that one started as a joke and still took off. Now, these digital currencies live on a decentralized ledger, meaning every transaction is recorded on a network of computers. It's like a massive group chat where everyone agrees on what happened, and once it's in, no one can change it. And even though these are not backed by central banks, they do function as currencies. Sometimes. You can use Bitcoin to buy a Tesla. Or you could, until Elon Musk changed his mind. Yep, that's right. That's volatility, folks. One Elon tweet or a new regulation and the whole market moves 20% in a day. That's why, despite adoption, central banks are exploring their own controlled version, called central bank digital currencies, or CBDCs. These are digital forms of fiat, but fully regulated and issued by the central bank. Think of it as the government saying, fine, you want digital money? We'll make our own. But cryptocurrencies also function like securities, commodities, or even property, depending on how you're using them and where you're using them. Regulation varies wildly, country to country. Now let's talk tokens. These are not currencies per se. They represent rights or access and are built on existing blockchains. Tokens fall into categories based on what they're meant to do. So, folks, remember, tokens are also digital assets, but unlike cryptocurrencies, which are generally meant to act as money or a store of value, tokens represent rights or access. They're built on existing blockchains like Ethereum, and they're programmable, flexible, and often highly specialized. One key concept here is tokenization. That's the process of turning a real-world asset into a digital token. So whether it's real estate, artwork, or even a barrel of oil, you can represent ownership of that asset on the blockchain with a token. That makes it easier to transfer, divide, and verify. Let's run through the different types. So, there are 5 you need to know. First, we've got non-fungible tokens, NFTs. These are the unique ones. Each NFT is one of a kind and usually linked to digital assets like artwork, music, or collectibles. The blockchain holds the certificate of authenticity. One NFT might represent a digital painting. Another might be tied to a music file or video clip. Their uniqueness is what gives them value. And the authenticity of ownership, that's stored right on the blockchain. So, for example, you could mint a digital Mona Lisa as an NFT, and whoever holds that token owns the original file. So, artists can sell directly to fans, and smart contracts even let them earn royalties on resale. But yeah, the market's full of hype and price swings like crazy. Then come security tokens. These are the ones that start to look like real securities. Security tokens represent ownership, like stocks, bonds, or real estate shares, digitized and recorded on the blockchain. Why bother? Because they make settlement and custody much faster and cheaper. You don't need a bunch of middlemen to verify trades anymore. It's all recorded, all automated. Moving on, we've got utility tokens. These are functional. These are like arcade tokens. They're used to access services on a network, like paying gas fees on Ethereum or unlocking premium features in a blockchain-based game or platform. Key point, utility tokens don't offer ownership or dividends. They're just functional. And then governance tokens. These let holders vote on how a blockchain or protocol operates. Want to change the interest rate on a DeFi platform? If you hold governance tokens, you can vote. It's kind of like being a shareholder in a decentralized system, but instead of voting on CEOs, you're voting on algorithms and code. For example, if you own governance tokens for a DeFi platform like Uniswap, you can vote on protocol changes, like fee structures, new features, or token distributions. It's like being a shareholder in a decentralized company. And finally, ICOs, initial coin offerings. These are basically the crypto world's version of IPOs. Companies raise money by issuing tokens to the public, faster and cheaper than traditional IPOs, but yeah, usually unregulated and full of investor risk. No voting rights, no guarantees. The CFA exam may test your understanding of how these differ from traditional fundraising methods like IPOs. All right, so here's what you really need to take with you for the exam. Cryptocurrencies are decentralized, not backed by governments, and mainly used as digital money, like Bitcoin, Ethereum, and stablecoins. Tokens are programmable assets that can represent ownership, access, or voting rights, things like NFTs, security tokens, utility tokens, and governance tokens. And ICOs? They're crypto fundraising tools, cheaper and faster than IPOs, but riskier and less regulated. Just remember, CFA Institute will test whether you can tell these apart and explain how each fits into a portfolio or funding strategy. Know the difference and know the why. Okay, folks, let's pause and take a breath. Because this right here, this section, is where a lot of CFA candidates start mixing things up. You've heard about Bitcoin, maybe you've even dabbled in crypto with a friend who swears it'll go to the moon, but in the exam, well, things get real. So let's slow it down and really understand what digital asset investment features are all about and how they compare to traditional assets. And hey, while you're at it, have a look at the Battle Ready summary we've got on screen right now. It's structured in a way that connects the exam concept with how this stuff works in the real world. If you don't already have these summaries from FinQuiz, trust me, you're missing out. Links in the description, and it's hands down one of the best tools to cut through the noise. All right, moving on. Let's start with the growth story. Back in 2013, there were just 70 cryptocurrencies. 70. Fast forward to early 2022, and boom, we're looking at nearly 10,000 digital assets. That's not a trend, that's a tidal wave. And naturally, when institutional investors see something that volatile and exciting, they start sniffing around for opportunity. Hedge funds, wealth managers, even pension funds, they're now carving out slices of their portfolios to test this asset class. Now, what makes digital assets so different from traditional ones? Let's start with a small similarity. Both traditional and digital assets can be accessed indirectly. Think ETFs, hedge funds, fund-of-funds structures. That's your basic gateway. But from here, the paths split. First, let's talk inherent value. Traditional assets like stocks or bonds are backed by something tangible. You've got dividends, coupons, assets, future earnings, something to hold on to. Digital assets? Not quite. There's no cash flow, no hard asset backing them. Their value comes from what people believe they're worth: scarcity, hype, utility, and let's be honest, speculation. It's like owning a collectible baseball card, valuable only if someone else wants it. Next, transaction validation. Traditional assets rely on central intermediaries, banks, brokers, clearinghouses. You want to buy a share of Apple? There's a whole behind-the-scenes relay race happening to make that trade settle. But with digital assets, validation happens on decentralized ledgers. Think blockchains, advanced cryptographic algorithms, consensus mechanisms like proof of stake. No middleman, just code and math. Okay, next one's big: medium of exchange. In theory, cryptocurrencies like Bitcoin could replace fiat in online transactions. Some companies do accept crypto. You've seen the pay with Bitcoin option online, but for now it's mostly within ecosystems like Web3. High fees, legal uncertainty, and volatility make it a tough sell for mainstream adoption. I mean, imagine trying to pay for your Uber ride and the price of ETH drops 15% between entering and exiting the car. Yeah, awkward. And lastly, there's regulation. Traditional markets are tightly regulated, right? You've got the SEC, FSA, all kinds of investor protections. If you buy a bond and something goes wrong, you've got legal recourse. But digital assets, it's still the Wild West out there. No standardized protections, no clear legal framework in many countries. Fraud, manipulation, and pump and dump schemes are still pretty rampant. That's why regulators around the world are scrambling to keep up. Okay, let me give you the exam tip. CFA Institute loves comparison questions. Be ready to recognize how digital assets differ from traditional ones, not just in theory, but in application. Think validation, value, regulation, and transaction use. Now let's turn to what the curriculum calls investable digital assets. This part's fun because we're getting into names you've heard and maybe even own. Let's start with the OG Bitcoin. Launched in 2009, Bitcoin was designed as a peer-to-peer payment system free from government control. And sure, it can still be used for transactions. But let's be honest, most people treat it like digital gold. It's more of a store of value than a currency at this point. Investors buy it, hold it, and pray it hits six figures. Institutions now view it like an alternative asset, just like they would with gold or art. Then we've got altcoins. These are the alternatives to Bitcoin, coins like Ethereum, Solana, Cardano, and the like. Some of these offer functionalities that go way beyond simple payments. Take Ethereum, for example. It introduced programmable money, smart contracts that let you build entire applications on the blockchain. Think of it like Apple's App Store, but without the gatekeeper. Then there's a special category, stable coins. Now this one's fascinating. These are digital currencies pegged to real-world assets like the US dollar or gold. The goal here? Stability. You're not holding stablecoins to get rich. You're using them for fast, cheap, cross-border transactions without the risk of value swinging wildly. And within stablecoins, we have two flavors: smart stablecoins, which use algorithms to control supply and keep prices stable. Asset-backed tokens, which are backed by real reserves like US dollar or gold. But here's the catch: they usually can't be redeemed for actual fiat. And regulatory backing, still shaky. And oh yes, how can we forget the meme coins? Dogecoin, Shiba Inu, and their chaotic cousins. These are coins inspired by jokes, tweets, and sometimes pure internet randomness. They're volatile, risky, and yet wildly popular. Ask any Gen Z trader what their favorite coin is, and chances are they'll name something that started as a joke on Reddit. Not even kidding. Now, for the exam, folks, you need to remember the categories: Bitcoin, altcoins, stablecoins, and meme coins, and their use cases, risks, and technological differences. That's a favorite CFA setup. Give you a few features and ask you to identify the coin type. And hey, all of this is right there, summarized beautifully in our FinQuiz Battle Ready summary. This isn't just a recap, it's a power tool, something you want to review before bed, in the Uber, or right before the exam. It maps out the details visually and compresses all the reading into something memorable. So hit the link in the description if you haven't downloaded these yet. It's not just this summary. We've got formula sheets, mock exams, question banks, and yes, full Stanley Notes if you want deeper dives. But for a quick exam day refresh, Battle Ready is your best bet. All right, ready for the next section? We're about to explore how these digital assets can be held directly or indirectly, and the sneaky little risks that come with each route. Let's keep going. Okay, so by now you probably get that digital assets aren't just this mysterious digital mist floating around. They're real, they're investable, and more importantly, they come in different forms. Now, this is one of those sections where CFA Institute expects you to know not just what crypto is, but how investors actually hold it. And believe me, this stuff is showing up on the exam. So listen closely. All right, let's get into it. So there are three main ways to get exposure to digital assets: direct ownership, indirect ownership, or through digital tokens backed by non-digital real-world assets. Let's start with direct digital ownership, sometimes referred to as on-chain. This means you actually hold the asset yourself. You buy it, you store it, you own the keys. But with great power comes, yep, you guessed it, great risk. To hold crypto directly, you need a cryptocurrency wallet. That's how you store your public and private keys. Without your private key, you're locked out. It's like forgetting the password to your safe, and the safe melts down if you get it wrong. No forgot password option here. You can access digital assets through two types of exchanges. First, we have centralized exchanges, or CEXs. Think Coinbase, Binance, Kraken. These are easy to use, provide good liquidity and pricing, but they kind of contradict the whole decentralized dream of crypto. Why? Because your crypto sits on their servers, which means if they get hacked or go under, you could lose everything. And yes, these exchanges are often under the radar of regulators, so depending on where you live, they might face tighter rules. Then we have decentralized exchanges, or DEXs. These operate more like Bitcoin itself, peer-to-peer with no central authority. Uniswap, SushiSwap, those are big names in the DEX world. They're safer in theory, but clunkier for beginners and not exactly intuitive to navigate. Plus, the lack of regulation raises legal eyebrows. It's kind of like buying stocks in the 90s using a bulletin board. You really have to know what you're doing. Now, what are the risks of owning digital assets directly? Well, quite a few, actually. Fraud risk. You've probably heard of fake ICOs or pump and dump scams. They still happen. Loss of access, lose your wallet key, that's it. Game over. Some estimates say up to 20% of all Bitcoins are permanently inaccessible. Then there is price manipulation. Certain tokens are heavily influenced by a few large holders known as whales. They can move markets with a single trade. Now, let's move to indirect digital asset ownership, or what's called off-chain. Here, you're not holding crypto yourself. Instead, you're investing in products that give you exposure to crypto without having to touch a wallet or blockchain directly. This is how most institutional investors tiptoe into crypto because it's cleaner, safer, and fits into existing portfolio structures. Let's break down your options here. Cryptocurrency coin trusts. These are like crypto mutual funds. You invest in a trust that holds a bunch of crypto. Grayscale's Bitcoin Trust is a well-known example. No wallet needed, but fees can be high, and the price might trade at a premium or discount to the actual value of the crypto inside. Cryptocurrency futures contracts. Now this one's spicy. Futures let you speculate on the price of crypto at a future date. They're settled in cash, not coins. But here's the catch. High leverage, high volatility, and less developed markets. Think of it as trading crypto with rocket fuel. Exciting, but you could burn out fast. Now, cryptocurrency ETFs. These track crypto performance using derivatives. You're not owning crypto, but you get exposure to the price movement. These are generally more diversified and come with lower fees, but again, they may not perfectly mimic the underlying asset. It's like riding in a car behind a race car. Close, but not quite the real thing. Cryptocurrency stocks. This includes companies like Coinbase, PayPal, or even Nvidia, which supplies GPU chips used in crypto mining. When you invest in these, you're getting indirect exposure to the digital asset space through their revenue models. Now, hedge funds. This one's for the big leagues. Crypto hedge funds offer everything from long-short strategies to quant-based algorithms. Some even mine Bitcoin themselves to boost returns. That's right, they're not just investing, they're participating in the ecosystem. Now, here's something you folks must remember. Direct or indirect ownership isn't just about access. It affects risk, return potential, legal implications, and how the investment fits into a portfolio. That's a classic trap. Don't fall for it. Now on to the third category, and honestly, one of the most fascinating shifts in modern finance. Digital forms of investment for non-digital assets. Wait, what? Digital investments in physical assets? Yep. We're talking about asset-backed tokens. Imagine taking a bar of gold or a commercial building in Dubai and splitting it into 1,000 digital tokens. That's tokenization. Each token represents a slice of ownership in the real asset. And because it's on the blockchain, the transaction record is permanent, secure, and transparent. Why is this useful? Well, it increases liquidity. You can sell 1/100th of a tokenized real estate project, which you can't do with a real building. It also lowers costs. You don't need lawyers and brokers for every deal. And yes, regulators treat these tokens as securities because they represent ownership in something tangible. Now let's talk about the star of the show, DeFi, decentralized finance. DeFi is this growing ecosystem of financial services built entirely on blockchain platforms. No banks, no institutions, no gatekeepers. The apps built under DeFi are called dApps. decentralized applications. They let users lend, borrow, trade, earn interest, and more, all without ever interacting with a centralized company. And what makes these dApps work? Smart contracts, self-executing agreements coded directly into the blockchain. Once conditions are met, boom, the contract executes. No need to wait for someone to manually click approve. Imagine a world where your loan gets issued instantly after you meet collateral requirements without any paperwork. That's not future talk. That's DeFi, and it's happening now. So, in a nutshell, DeFi aims to replicate pretty much everything you can do in traditional finance: lending, borrowing, trading, saving, but in a decentralized manner using dApps. People around the world can engage in financial transactions without going through traditional banks or brokers. It's all driven by smart contracts. On the exam, you might see references to how DeFi tries to break down barriers like expensive cross-border transactions and lengthy settlement times. However, it does present new risks, especially since it's largely unregulated. And if you're feeling overwhelmed, don't worry. That's exactly why we created these FinQuiz battle-ready summaries. They break this complex topic into visual chunks, connect the dots, and keep your head clear for the exam. You'll remember how asset-backed tokens differ from crypto ETFs because you've seen it mapped out this way. Hit the link in the description to get access, not just to this one, but to all battle-ready summaries across all topics. Everything's designed to make sure you walk into that exam room sharp, confident, and actually enjoying topics like this. All right, team, this is our final stretch in the world of digital assets. And let me tell you, this section is where the rubber meets the road. Because up until now, we've talked about what digital assets are, how to invest in them, and the forms they take. But now we get to the core question every investor eventually asks: is it worth the risk? And I'm going to be honest, this section is pure CFA gold. They love testing this because it blends finance fundamentals with real-world uncertainty. And it separates the candidates who memorize definitions from those who actually understand portfolio risk. So let's get into it. Digital assets, Bitcoin, Ethereum, and the rest have exploded in popularity, not just among techies and Reddit traders, but with serious institutional investors. Why? Because the returns have been outrageous. Just to give you some context, back in 2010, you could buy one Bitcoin for 5 cents. By 2021, it hit $68,789. That's not just a return, it's financial whiplash. But with that kind of growth comes volatility, and volatility means risk. Let's talk about the risks and return profile of digital assets. First, these assets have limited underlying value. Unlike a stock, you're not buying future cash flows. Unlike a bond, you're not collecting interest. The value is purely based on price appreciation and demand. So yeah, it's speculative. Second, price is heavily demand driven. Bitcoin, for example, has a hard cap of 21 million coins. So scarcity drives the price, but demand can be fickle, rising with hype, crashing with headlines. And let's not forget volatility. I mean, even in 2024, Bitcoin was still bouncing 10 to 15% in a week. That's not something your average retirement investor can stomach. There's also uncertain investment potential. Sure, Bitcoin made headlines, but thousands of other coins have tanked, vanished, or become ghost towns on the blockchain. Not every project survives the next cycle. Now add in legal gray areas, because let's be real, regulation is still catching up. In the US, crypto is treated as a commodity. In Europe, there's pending regulation. And in some countries, it's outright banned. And then there's the dirty word fraud. From fake ICOs to hacked wallets to celebrities promoting pump and dump schemes, this space is full of landmines. The tech may be elegant, but the human behavior? Not always. Now, in the exam, if they give you a scenario with no cash flows, high volatility, price dependence on demand, and regulatory uncertainty, you're probably looking at a question on digital asset risk. All right, now let's flip the coin. Let's talk about diversification benefits. This is what got hedge funds interested. Cryptocurrencies, especially in their early years, showed low correlation with traditional asset classes. That made them appealing as a non-traditional portfolio addition. So what drives crypto prices? It's a weird mix. Tech adoption, network growth, speculation, regulation, and good old-fashioned market hype. Because of these unique drivers, crypto didn't move in sync with stocks or bonds for a while. But here's the catch. As crypto becomes more institutionalized, its correlation with traditional markets is increasing. So that edge, it might not last forever. Still, as of now, there's a case to be made for crypto as an alternative investment. Just maybe not for your grandmother's retirement fund. And remember, correlation isn't static. The moment enough investors start treating crypto like stocks, it starts behaving like stocks. So here's what to expect on exam day. You'll get questions asking you to compare digital and traditional asset risk. You might see scenarios testing volatility, liquidity risk, legal risk, or fraud. Be ready to evaluate crypto as an alternative investment and discuss its diversification benefits. And hey, if this feels like a lot, it is. Which is why we built our battle-ready summaries at FinQuiz. These summaries don't just help you revise. They help you remember under pressure. We designed them to break down big concepts visually, logically, and in a way your brain can actually recall in the exam room. So hit the link in the description, grab your copy, and while you're at it, check out our FinQuiz formula sheets, Stanley Notes, mock exams, and question bank. Whether you're aiming for 90% or just want to clear the hurdle, this will get you there. All right, that's it for this learning module. We've officially wrapped the digital assets reading. You've now got the background and types of digital assets, how DLT and blockchain work, different investment forms, and the risks, the rewards, and the portfolio considerations. And now you've got the edge, folks. So stay focused, keep practicing, and don't forget, we're with you all the way. This is FinQuiz, and we don't just help you study, we help you pass. See you in the next video.